Have you ever looked at a company and just wondered what's really going on under the hood? Well, today, we're basically going to become financial detectives. We're going to demystify how you can check a company's health, not just for 1 year, but over 3, to see the real unvarnished story. So let's get into it.
At the end of the day, this is the one question we're trying to answer. Think of it like a doctor's checkup for a business. We're not just asking, hey, how are you feeling today? We need to understand its underlying health and, more importantly, where it's headed. And just like a doctor, we have a specific chart to read.
Because here's the thing. Looking at just 1 year of data can be totally misleading. A company can have a great year, a lucky year, right? But that's just a snapshot in time. A 3-year trend, though, that reveals the real narrative. Is the company getting stronger, or is it slowly starting to fade? That's the truth we're after.
And the main tool we're going to use for this checkup is the income statement. Seriously, just think of it as the patient's chart. It tracks the flow of money over time, and the formula is beautifully simple. You take all the sales, you subtract all the expenses, and what's left is the profit. That's the story it tells.
Okay, so we've got our patient's chart in hand. Now it's time for the actual examination. We're going to check 4 key vital signs. These are the core metrics that, when you look at them together, give you a super clear diagnosis of a company's financial health. So, our first vital sign is revenue growth, what people often call the top line. This is basically the company's pulse. It's the total amount of money coming in the door from sales before a single penny is taken out for expenses. The question here is super simple. Are they selling more stuff this year than they did last year?
And here's a perfect example of a really healthy pulse. In year 1, the company brought in $1 million. By year 3, that number doubled to $2 million. That is a clear, strong, positive trend. It shows that more and more people want what they're selling.
So a trend like that tells you customers are probably happy. Maybe the market itself is growing. But if that trend were going downward, whoa, that is a major red flag. It could mean customers are leaving, maybe jumping ship to a competitor.
All right, our next vital sign, gross margin, goes a little deeper. It's not just about how much you sell. It's about how profitably you sell it. So for every dollar that comes in, what percentage is left over after you pay for the direct costs of making the product itself? The raw materials, that kind of thing. It's a fantastic measure of how efficient the company is at its core business.
And here, we see another great trend. The company isn't just selling more, it's actually getting better at making money on each sale. In year 1, they kept 40 cents of every dollar. By year 3, they're keeping 45 cents. That's a clear sign of improving efficiency.
An increasing margin like this, it tells a story of strength. It means the company's either getting smarter about production costs or, and this is huge, it has the power to raise its prices without scaring customers away. A decreasing margin, though, that points to weakness. Maybe their costs are going up or they're being forced into a price war.
Vital sign number 3 is the operating margin. Now, if gross margin was about making the product efficiently, operating margin is about running the whole show efficiently. This looks at the profit after you've paid for all the daily stuff, rent, salaries, marketing, the whole shebang. This is a direct reflection of how good the management team is.
And would you look at that? Another positive trend, rising from 15 to 20%. This is a sign of really smart growth. As sales are getting bigger, the management team is making sure the overhead costs aren't ballooning out of control. Honestly, a rising operating margin is one of the best signs of a well-run company. It shows the leadership is making sure that as the business gets bigger, it also gets better and more profitable, not just, more bloated.
And that brings us to our final and probably most famous vital sign, net income. This is it, the bottom line. After every single cost has been paid, materials, rent, salaries, even taxes and interest on debt, this is the actual final profit. This is the money the company actually gets to keep.
And this is what it's all about, right? A healthy, growing bottom line. You can see how that strong revenue growth and those improving margins we saw earlier led directly to this, a final profit that's climbing steadily every single year. This is what a healthy patient looks like.
But here's the most important warning I can give you. A company can have absolutely skyrocketing revenue. That first vital sign can look amazing, but it can still end up with negative net income. If their expenses are out of control, those huge sales numbers mean nothing. The bottom line is the ultimate test. Are they actually making any money?
So, we've checked all 4 vital signs, we've collected the data from our patient's chart. Now, it's time to put it all together and make our diagnosis.
What does the complete picture really tell us about this company's health?
By combining these four vitals, we can usually diagnose one of three common scenarios. You've got a company with good, healthy performance, one that's suffering from what I call profitless growth, or a company that's just plain inconsistent and risky. Let's break those down.
First up, the dream scenario. Good performance. The top line revenue is growing strong, and the bottom line, net income, is growing right there with it. When all the vital signs are positive like this, it points to a healthy, well-run, and probably pretty dominant company. Now this next one is a really dangerous trap. Profitless growth. Just look at this. The revenue is exploding. It's tripled in 3 years. But the net income? It's plummeting all the way into a loss. This company is spending way too much money to get those sales, and it's becoming less healthy with every new customer. This is a classic recipe for disaster. And finally, you have the inconsistent company. I mean, the numbers are just all over the place. Up, then down, then back up again. This suggests a pretty risky business model. Maybe their sales depend on things they can't control, like the weather or the price of oil. It's not necessarily unhealthy, but it is for sure a volatile and unpredictable ride.
So, after our full examination and our diagnosis, let's just boil this entire thing down into one final report card. A single, powerful question that really sums up everything we've just learned.
It all comes down to this. You can forget all the jargon for a second and just ask yourself this one thing. Is this company selling more stuff? And, this is the critical part, are they getting better at keeping the profit, or are they just wasting money? Answering that forces you to look at both growth and efficiency. It really is the key. And there you have it. You now have the tools to be a financial detective, to look past all the hype and the headlines, and to read the real story that's written in the numbers. So the next time you look at a company, you can do your own little checkup. The only question left is, what story are you going to uncover?
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.